电法人关系处的苏志凯，欢迎您参加台积公司2021年第三季的法人说明会。为防范新冠肺炎疫情扩散，本次法人说明会仍采电话会议进行。由于本法说会是向全球投资人同时连线转播，所以我们会全程使用英文，请您见谅。Good afternoon, everyone, and welcome to TSMC's third quarter 2021 earnings conference call. This is Jeff Su, TSMC's Director of Investor Relations and your host for today. To prevent the spread of COVID-19, TSMC is hosting our earnings conference call via live audio webcast through the company's website at www.tsmc.com, where you can also download the earnings release materials. If you are joining us through the conference call, your dial-in lines are in listen-only mode. The format for today's event will be as follows. First, TSMC's Vice President and CFO, Mr. Wendell Huang, will summarize our operations in the third quarter 2021, followed by our guidance for the fourth quarter 2021. Afterwards, Mr. Huang and TSMC's CEO, Dr. C.C. Wei, will jointly provide the company's key messages. Then we will open the line for Q&A. As usual, I would like to remind everybody that today's discussions may contain forward-looking statements that are subject to significant risks and uncertainties, which could cause actual results to differ materially from those contained in the forward-looking statements. Please refer to the safe harbor notice that appears on our press release. And now, I would like to turn the call over to TSMC's CFO, Mr. Wendell Huang, for the summary of operations and the current quarter guidance.
Thank you, Jeff. Third quarter revenue increased 11.4% sequentially in NT terms, or 12% in dollar terms. Our third quarter business was driven by strong demand across all four growth platforms, which are smartphone, HPC, IoT, and automotive-related applications. Gross margin increased 1.3 percentage points sequentially to 51.3%, mainly due to the improvement in back-end profitability and a more favorable technology mix. Operating margin increased 2.1 percentage points sequentially to 41.2%, mainly due to better operating leverage. Overall, our third quarter EPS was 6.03 NT, and ROE was 30.7%. Now let's move on to the revenue by technology. 5 nanometer process technology contributed 18% of wafer revenue in the third quarter, while 7 nanometer accounted for 34%. Advanced technologies, which are defined as 7 nanometer and below, accounted for 52% of wafer revenue. Now moving on to revenue contribution by platform. Smartphone increased 15% quarter over quarter to account for 44% of our third quarter revenue. HPC increased 9% to account for 37%. IoT increased 23% to account for 9%. Automotive increased 5% to account for 4%, and DCE decreased 2% to account for 3%. Moving on to the balance sheet, we ended the third quarter with cash and marketable securities of 976 billion NT, or equivalent $35 billion US. On the liability side, current liabilities increased 8 billion NT, mainly due to the increase of 24 billion in accounts payables and the increase of 6 billion in dividend payable, partially offset by the decrease of 21 billion in short-term loans. Long-term interest-bearing debt increased by 50 billion NT, mainly as we raised 49 billion corporate bonds during the quarter. On financial ratios, accounts receivable turnover days decreased 2 days to 40 days, while days of inventory remained at 85 days. Now let me make a few comments on cash flow and CAPEX. During the third quarter, we generated about 319 billion NT in cash from operations, including some customer prepayments, spent 189 billion in capex, and distributed 65 billion for fourth quarter 20 cash dividend. Short-term loans decreased 18 billion, while bonds payable increased by 49 billion. Overall, our cash balance increased 106 billion to 854 billion at the end of the quarter. In US dollar terms, our third quarter capital expenditures total $6.77 billion US dollars. I have finished my financial summary. Now let's turn on to our fourth quarter guidance. Based on the current business outlook, we expect our fourth quarter revenue to be between 15.4 billion and 15.7 billion US dollars, which represents a 4.5% sequential increase at the midpoint. Based on the exchange rate assumption of $1 US to 28 NT, gross margin is expected to be between 51% and 53%, operating margin between 39% and 41%. On July 12th, we announced we have completed the purchase of 5 million doses of vaccine as part of our efforts to help fight against COVID-19 pandemic in Taiwan. We recognized a small portion of the vaccine donation expense in the third quarter, and the majority of it will be recognized in the fourth quarter, which will have around 1 percentage point impact on our operating margin. This concludes my financial presentation. Now, let me turn to our key messages. I will start by making some comments on our 2021 capital budget. Every year, our capex is spent in anticipation of the growth that will follow in future years. We are witnessing a structural increase in underlying semiconductor demand underpinned by the industry megatrends of 5G-related and HPC applications. In order to support our customers' growth and meet the increasing demand for our advanced and specialty technologies in the next several years, we have budgeted our full year 2021 capex to be around 30 billion US dollars. Next, let me talk about our profitability. Our third quarter gross margin increased 1.3 percentage points sequentially to 51.3%, mainly due to better back-end profitability and technology mix. Based on the exchange rate assumption of $1 US to 28 NT, we have just guided fourth quarter 2021 gross margin to be 52% at the midpoint. The midpoint of our fourth quarter gross margin guidance also implies that our full year 2021 gross margin is expected to be higher than 50%, despite the rapidly rising depreciation cost, the dilution from M5 ramp, and the unfavorable foreign exchange rate in 2021 as compared to 2020. As we have discussed before, 6 factors determine TSMC's profitability: leadership, technology development and ramp-up, pricing, cost, capacity utilization, technology mix, and foreign exchange rate, which is not controllable. Taking all these factors into consideration, we believe a long-term gross margin of 50% and higher is achievable. Now let me turn the microphone over to CC.
Thank you, Wendell. We hope everybody is staying safe and healthy during this time. First, let me start with our near-term demand and inventory. We concluded our third quarter with revenue of NT 414.7 billion, or US dollar 14.9 billion, driven by strong demand across all 4 growth platforms, which are smartphone, HPC, IoT, and automotive-related applications. Moving into fourth quarter 2021, we expect our sequential growth to be supported by strong demand for our industry-leading 5-nanometer technology. Based on the midpoint of our fourth quarter revenue guidance, our full year 2021 revenue is expected to grow about 24% year-over-year in US dollar terms. On the inventory front, we continue to expect our customers and the supply chain to gradually prepare a higher level of inventory in the second half of this year as compared to the historical seasonal level. Given the industry continued need to ensure supply security, we expect the supply chain to maintain a higher level of inventory for a longer period of time. In the near term, we continue to observe short-term imbalances due to interruptions in the supply chain brought about by COVID-19. We also continue to observe the structural increase in long-term demand underpinned by the industry megatrends of 5G and HPC-related applications, and the higher silicon content in many end devices, including automotive, PCs, servers, networking, and smartphones. While the short-term imbalances may or may not persist, we believe our technology leadership will enable TSMC to capture the strong demand for our advanced and specialty technologies, and we expect our capacity to remain tight in 2021 and throughout 2022. Next, let me talk about TSMC's long-term growth driver and return. We are entering a period of higher structural growth. The multi-year megatrend of 5G and HPC-related applications are expected to fuel massive requirement for computation power and propel greater need for energy-efficient computing, which demand the use of leading-edge technologies. These megatrends will not only spur unit growth, but also drive increasing semiconductor content in HPC, smartphone, automotive, and IoT applications. COVID-19 has also fundamentally accelerated the digital transformation, making semiconductors more pervasive and essential in people's lives. With our technology leadership, manufacturing excellence, and customer trust, TSMC is better positioned to capture the growth from the favorable industry megatrend with our differentiated technologies. To address the structural increase in the long-term market demand profile, TSMC is working closely with our customers to plan our capacity and investing in leading-edge and specialty technologies to support their demand. Our capital investment decisions are based on 4 disciplines: technology leadership, flexible and responsive manufacturing, retaining customers' trust, and earning the proper return. At the same time, we face manufacturing cost challenges due to increasing process complexity at leading node, new investment in mature nodes, expansion of our global manufacturing footprint, and rising material and basic commodity costs. As we continue to work closely with our customers to support their growth, our pricing strategy will remain strategic, not opportunistic, to reflect our value creation. We will also continue to work diligently with our supplier to deliver on cost improvement. Even as we shoulder a greater burden of investment for the industry, by taking such actions, we believe we can achieve a proper return that enables us to invest to support our customers' growth and deliver long-term profitable growth with 50% and higher gross margin for our shareholders. Now let me talk about our Japan fab plan. We are expanding our manufacturing footprint to sustain and enhance our competitive advantage in providing industry-leading technologies the world's largest logic capacity, efficient and cost-effective manufacturing, and to better serve our customer. Our global manufacturing expansion strategy is based on customers' need, business opportunities, operating efficiency, and cost economic considerations. After conducting due diligence, we announced our intention to build a specialty technology fab in Japan, subject to our board of directors' approval. We have received a strong commitment to support this project from both our customers and the Japanese government. This fab will utilize 22-28 nanometer technology for semiconductor wafer fabrication. Fab construction is scheduled to begin in 2022, and production is targeted to begin in late 2024. Further details will be provided subject to the board approval. We believe the expansion of our global manufacturing footprint will enable us to better serve our customers' needs and reach global talent while earning the proper return from our investments and deliver long-term profitable growth for our shareholders. Finally, I will talk about the N3 and N3E status. Our N3 technology will use FinFET transistor structure to deliver the best technology maturity, performance, and cost for our customers. Our N3 technology development is on track. We have developed complete platform support for both HPC and smartphone applications. N3 risk production is scheduled in 2021, and production will start in second half of 2022. We continue to see a high level of customer engagement at N3 and expect more new tape-out for N3 for the first year as compared with N5. We also introduced N3E as an extension of our N3 family. N3E will feature improved manufacturing process window with better performance, power, and yield. Volume production of N3E is scheduled for 1 year after N3. Our 3-nanometer technology will be the most advanced foundry technology in both PPA and transistor technology when it is introduced. With our technology leadership and strong customer demand, we are confident that N3 family will be another large and long-lasting node for TSMC. This concludes our key message. Thank you for your attention.
Thank you, CC. This concludes our prepared statements. Before we begin the Q&A session, I would like to remind everybody to please limit your questions to 2 at a time, to allow all the participants an opportunity to ask questions. Should you wish to raise your question in Chinese, I will translate it to English before our management answers your question. For those of you on the call, if you would like to ask a question, please press the 0, then the 1 key on your telephone keypad now. Questions will be taken in the order in which they were received. If at any time you would like to remove yourself from the questioning queue, please press 02. Now, let's begin the Q&A session. Operator, please proceed with the first caller on the line.
Yes, the first one to ask questions, Gokul Hariharan, JP Morgan.
Good afternoon. Congrats on the good results, and thanks for taking my question. My first question is on the long-term roadmap. Intel has now unveiled their long-term roadmap until 2025 with 4 process nodes, looking to catch up with TSMC and potentially even overtake. Could TSMC talk a little bit more about its own longer-term roadmap, timing of adoption of some of the new technologies like gate-all-around, high-NA EUV, buried power line, etc.? And where does TSMC see itself from a process technology leadership perspective in the next 3 to 5 years? The entry message is definitely well received, but maybe could we talk a little bit more longer term, given some of your competitors are kind of addressing that kind of time frame as well? That's my first question.
Okay, thank you, Gokul. Please let me summarize your first question. So Gokul's first question is about regards to our long-term technology roadmap. He notes that in IDM, is outlined their long-term roadmap for the next 3 to 5 years, and talking about catching up and overtaking. So Gokul wants to know what are our views or plans, or our roadmap, around the timing of new technologies, such as new transistor structure like gate-all-around, high NA, etc., and how do we see our technology leadership position in the next 3 to 5 years?
Okay, Gokul. I don't comment on my competitors' technology roadmap or their technology approaches, but for TSMC, we are confident that we will be very competitive, and we do have a very competitive schedule. Actually, let me say that in our 3-nanometer technology and the 2-nanometer technology. And I can share with you that in our 2-nanometer technology, the density and performance will be the most competitive in 2025. And of course, I can also share with you that the gate-all-around structure is being considered, although I am not going to, not ready to release more information about it. So that's, again, let me conclude in one sentence. We have become very competitive, and we are confident that our technology leadership will be maintained.
Okay. Thank you, CC. Gokul, do you have a second question?
Yes, thanks for the answer. Looking at CapEx, I think back in Q1 results, TSMC indicated spending $100 billion plus in CapEx over the next 3 years. Since then, you have talked about Japan capacity expansion. Looks like there are some capacity expansion plans for leading edge in Kaohsiung as well. Could we talk a little bit about, is $100 billion going to be enough, or do you still see some upside to this $100 billion budget on the CapEx over the next 3 to 4 years, since the growth seems to be stronger? And if we see that upside in CapEx, are we still looking at the high end of 10 to 15% growth CAGR, or do we believe that there could be faster growth than this 10 to 15% or high end of 10 to 15% that we had talked about previously? Thank you.
Okay, Gokul, let me see if I can catch your second question. Is around our CapEx and growth, longer-term CapEx and growth outlook. So Gokul is asking, with sort of our plans in Japan and plans for expansion in Taiwan, will there be upside to this $100 billion CapEx number that we have talked about in the previous for the next few years? And then also, will there be a higher long-term growth CAGR target as a result as well?
Okay. Gokul, this is Wendell. Let me answer your question. We are not able to comment specifically on next few years' CAPEX. Our capital investment decisions are based on 4 disciplines: technology leadership, flexible and responsive manufacturing, retaining customers' trust, and earning the proper return, as CC just mentioned. Every year, our CAPEX is spent in anticipation of the growth that will follow in future years. As we said, we are witnessing a structural increase in underlying semiconductor demand, underpinned by the industry megatrends of 5G-related and HPC applications, and increasing silicon content. So, as long as our growth outlook looks good, there could be upside to our CAPEX plans, and we will continue our disciplined investment approach to support our customers and capture the growth opportunities. Now, in terms of our revenue CAGR, we're not planning to make any changes at this moment. We will provide you with more information in our January conference.
Okay.
Thank you. Thank you very much.
Okay, thank you, Gokul. Operator, can we move on to the next participant on the line, please?
Next one to ask question, Bruce Lu from Goldman Sachs. Go ahead, please.
Hi, thank you for taking my question. I think my first question is that 80% of TSMC's capex is focused on the advanced node capacity expansion. And do you see that the mature node becomes the bottleneck for your customers? How do you ensure your customer can have enough mature node chips?
Okay, sorry, Bruce, let me repeat your question. Question is around the mature nodes, and that with 80, typically majority of our capex is for the leading nodes. So how can we ensure that our customers will not be bottlenecked or have enough on the mature nodes as well?
Okay, Bruce, let me answer that question. TSMC's strategy at mature nodes is to work closely with our customers to develop and invest in specialty technology solutions to meet customers' requirements and create differentiated and long-lasting value to customers. We take a holistic view and work with our customer to decide the optimal capacity to support their demand.
Okay, does that answer your first question, Bruce?
Yes, let me try to ask the different questions. So I think recently we have a lot of investors asking that there are a lot of noise from the end demand, such as from the TV or China smartphone. The inventory level is also at a higher level. But the foundry outlook remains very, very positive, and almost everyone is raising the capacity and capex. And can you try to tell the investor what's the discrepancy and where is the why the foundry can continue to see such a strong demand while the end demand is deteriorating?
Okay, so Bruce, let me summarize your second question here. The second question for Bruce is around looking at end demand and the foundry. Bruce notes that there's a lot of, I guess, noises about different types of end demand. However, the foundry outlook seems to be very positive. So how do we explain this disconnect or discrepancy?
Okay, Bruce. Let me say that while we do not rule out the possibility of an inventory correction, but we expect TSMC's capacity remain very tight in 2021 and throughout 2022. This is because of our technology leadership position. And even there is a correction to occur, we believe it could be less volatile for TSMC than previous downturn, as the underlying structural megatrend of 5G related and HPC applications, and actually the increasing silicon content in addition to the unit growth in end devices will continue. And again, with our technology leadership, we are better positioned to capture the mid to long-term growth opportunities. I hope that answers your question. There's a discrepancy between the demand and why it's still very tight in capacity.
Okay, Bruce.
Understand. Thank you.
Thank you, Bruce. Operator, can we move on to the next participant, please?
Next one, Randy Abrams, Credit Suisse.
Okay, yes, thank you. Good afternoon. I wanted to ask, probably for Wendell, a few questions on the margins. You mentioned 50% and above. Just a couple follow-ups on that. Should we think it's still within a couple points of 50, or with efforts to firm up pricing, you could push it higher? Just reflecting to maintain return on capital, you will have a higher asset base. And that's kind of first part of that question. And then within margin, if you could update us on the inefficiencies you had operating at a high level, if you've worked that out, and also if you have an initial view on depreciation for 2022.
Okay, Randy, let me summarize your question. So your question is about our margin. So Randy notes that we now say 50% and above. He wants to know, is this a couple points above? How high above? And will we be able to, to maintain our, I guess, ROIC or ROE as a result? And also that, in last time we had talked about sort of running at a high level of utilization and certain inefficiencies. So has that now become, more improved, or what is the outlook there? And also the depreciation outlook for 2022.
Okay, let me answer the last question first. Depreciation in 2022 will increase, but the magnitude we are going to tell you next year in January. For the margin, how many percentage point over 50%? We don't want to disclose it right now, but we hope we can tell you more in the January investor conference. And that will, of course, bring a better ROE than before due to the higher margin targets. You also asked about utilization.
Randy also asking about inefficiencies. When we had talked previously about when we run at a high level of utilization, less efficient cost improvement and things like that. So right. Randy is wondering, is this, is it continuing? Is it?
The utilization continues to be pretty high. At the same time, the cost improvement activities is ongoing. As a matter of fact, in the fourth quarter, we believe the margin will be better, partially because of the cost improvement activities.
Okay, great. Then second question I'll ask, and it's one quick follow-up actually related to utilization 50 and above. If you have a utilization view, is that a 90% or that's full capacity? And then the second question I have is on the capital intensity. One of the equipment suppliers, Tokyo Electron, they put up a slide about a moderating increase in capital intensity. So CapEx per K, they have it by 2 nanometer, just rising gradually to 210 million per 1,000 wafers. Could you discuss, if you can, a CapEx per K, either absolute or how you see that trending? And do you see that continuing to accelerate up, or actions you're taking to keep it more stable after the increase we've seen the past few years?
Okay, so Randy's second question is about capital intensity. He notes that Tokyo Electron is showing that the capital intensity or the CapEx per K is moderating the pace of increase, particularly as you get into 2 nanometer. So he is wondering if we can just comment on our CapEx per K.
Well, Randy, what I can share with you is that the CapEx per K for more and more advanced technology is normally higher. That's for sure. So, but at the same time, through selling our values and working with the customers and the suppliers, we believe we are able to still earn a proper return, which is at this moment a 50% and higher gross margin is achievable.
Okay, Randy?
Great, thank you.
Yep, thank you, Randy.
Okay, thank you.
Operator, can we move on to the next participant, please?
Next one to ask questions, Brett Simpson from Arete Research.
Yeah, thanks very much. My question was on the N3 introduction next year. Can you talk a bit about the ramp-up of N3? Is it going to be a typical ramp, very similar to the last couple of node ramps, or do you see the timing of this being different? And also, just in terms of the costs, there's a lot of talk about costs rising above expectations for N3 as you add more EUV layers. Can you just clarify how you see costs at N3 and whether you can still achieve a 70% density gain at that node? Thank you.
Okay, Brett, so your first question is around N3. Brett wants to know, with N3 ramping in the second half of next year, what type of ramp do we expect versus the prior nodes? Will it be typical or will the timing be different? And also on the N3 cost, what does the N3 cost structure look like? Is that your question, Brett?
That's right. Thanks, Jeff.
Okay, Brett, this is C.C. Wei. Let me answer your second part of the question first. N3's cost definitely is higher than N5. That is because of technology complexity. And, we have to use many new equipment, which is cost higher. But then the ramp up is very similar to the previous node, with many customers' engagement actually is higher than what we observed in the previous node. So second half of 2022 will be our mass production, but you can expect the revenue will be seen in first quarter of the 2023 because of it takes a long cycle time to have all those wafer out.
Oh, okay. So basically on 3 nanometer, this won't be typically you'd see your first revenue Q2 or Q3. It's going to be later next year. Is that right?
That's right.
Yeah, Brett, I think
Okay.
we have been consistently saying that N3 will begin the production in second half 2022. That has been a consistent message since we first introduced N3 in 2019.
Okay, great. And maybe just a follow-up on 28 nanometer. You just talked about a new fab that's coming on stream in 2024 in Japan. And can you maybe just clarify the latest thinking in terms of Europe? Is that another that we may see new fab expansion for TSMC? And then in terms of looking at the 28 nanometer node, there's a lot of capacity being expanded at the moment. Can you talk about what's driving this and why you think this will not lead to an oversupply situation in time? Thanks.
Okay, thank you, Brett. So Brett's second question is around 28 nanometer. Two parts. First, of course, that CC just announced our intention to build 28 nanometer in Japan. So Brett wants to know, do we have plans in Europe? And then the second part is that with 28 nanometer, what is driving the longer-term structural demand for 28? Is there a risk of oversupply of 28 nanometer?
Okay. We don't rule out the possibility of building a fab in other areas that including the Europe. However, we do emphasize when we build up a new capacity for 28 nanometer is almost all to serve the specialty technologies. For some of the specialty technology that is not offered by our competitor, and TSMC is working with our customer to meet their demand. So, is there any possibility of oversupply? Not for TSMC. Okay, that's all I can let you know.
That's great. Thank you, CC.
Okay, thank you, Brett. Operator, can we move on to the next participant, please?
Next one to ask questions, Roland Shi, Citigroup.
Hi, good afternoon. Thanks for taking my questions. So my first question is you have a global manufacturing expansion strategy to build more fabs overseas going forward. Like you said, you also don't exclude the possibility to build a fab in Europe. So my question is, is a joint venture with a local government or key customers an option for you to build this new fab overseas? Or you prefer to build a fab and 100% on, like what you did for those fabs in China or US you are building now?
Okay, Roland, your first question is about our overseas fabs. Roland wants to know, as we expand overseas, will we consider joint ventures with local governments or our key customers, or will we continue to, or will it be 100% owned like what we have done in China and in the U.S.?
Okay, Roland, let me answer this question first. Normally, as you mentioned, our overseas fabs, we normally own 100%. We do not consider a JV with government However, JV with other companies or key customers can be considered on a case-by-case basis.
Okay, thank you. Yeah. My second question is, now you set a short-term goal of a zero-emission growth by 2025, but you have to continue to invest in 5 nanometer, 3 nanometer, or even 2 nanometer before 2025. So how are you going to achieve this zero-emission growth target, and also in the meantime keep up with your expansion plan? So will this, this aggressive zero-emission growth, plan to decelerate your investment plans to meet your target? Thank you.
Okay, Roland. Roland's second question is asking, that our commitment recently announced to zero emissions growth by 2025. But as we continue to invest and expand on N5 and N3, how will we be able to achieve this target?
Okay, Roland, it's actually a net zero in 2050, not zero emission in 2025. We are going to do this first by working ourselves to save, to become more energy efficient, because a lot of the carbon emission comes from the electricity. Our production, we can try to minimize the carbon emission. And secondly, we are going to use more green energy, which is which will emit the most part of the carbon. And for whatever is left, it will depend on carbon trading, the carbon rights in the future. So that's the basic framework of achieving this net zero in 2050.
No, actually, I'm talking about zero emission growth. So you have this near-term target, zero emission growth by 2025. So I know this is different from this net zero in 2050.
Right, yeah. But the way to achieve those are pretty much the same.
I think Roland, your question is about net zero emissions growth by 2025, and Wendell said we have net zero emissions by 2050, right? So I think what Wendell is saying is that we will continue to invest in technology, but we are also, as Wendell just said, our own internal efforts, our use of renewable energies, carbon credits, and also working with our suppliers and our supply chain on green manufacturing to achieve and deliver on these targets.
Okay, understood. Thanks.
Okay, thank you, Roland. Operator, can we move on to the next caller, please?
Next one to ask question, Charlie Chan from Morgan Stanley.
Thanks. Good afternoon, gentlemen. So my first question is about the chip shortage situation. I think Chairman took an interview by Time magazine, and his view is that there should be more than sufficient finished chip in the supply chain. So can you help us or global investors to understand when do you think that chip shortage, especially for the automotive, can be fixed? And also your advice to no matter governments or car makers, besides asking you to provide the customer data, what would be a better way to manage the shortage issue going forward? Thank you.
Okay, so thank you, Charlie. Charlie's first question is around the chip shortage with several aspects to it. Charlie wants to know, with the chip shortage and also sort of observations of customers stockpiling chips, he wants to know that how do we see the situation and when can this be fixed, particularly for the automotive segment. And let me stop there first.
Yeah, for the automotive, let me specifically point it out. The automotive supply chain actually is quite long and complex. Is more complicated than we initially thought. But let me say that TSMC's participation in the global automotive IC market is only about 15%. And we are doing our part to support our automotive customer with what they need. However, we cannot solve the entire industry's supply challenge. And recent factors such as pandemic in Southeast Asia also affecting the auto IC supply. Again, we are actively taking the steps throughout the first half of this year to address the chip supply challenges for our automotive customer. And we also believe the wafer supply shortage is greatly reduced for our automotive customers, starting probably in third quarter. The end of OEM probably will wait for a couple of quarters to see it. That's our estimate.
Thank you very much. It's super helpful. And another question is about, again, the price hike, right? So I think news were reporting you decide to hike the price by 5% to 20%. So may we know, how do you determine the different range applying to different customers? What was the kind of strategic reason behind for different range of a price hike? And I know you don't really want to give the next year guidance, right? But based on that 5%, 20% price hike, in terms of a percentage of a gross margin improvement, can your window comment on the margin improvement? Thank you.
Okay, Charlie's second question is asking about pricing, and he is asking, that recently there's lots of news that we have, increased our price by anywhere from 5 to 20%. So he wants to know, how do we decide how much to increase for what types of nodes or customers, and then also what will be the impact to 2022 gross margin. Is that correct, Charlie?
Yes. Thank you.
Hi, Charlie. In fact, we do not comment on our pricing. This is a very private discussion between TSMC and our customer. But let me say that we continue to work closely with our customer to support their growth. That one need TSMC to expand the capacity to support their growth. It's for both leading edge technologies and specialty technologies. And so our wafers pricing strategy continue to be strategic, not opportunistic or short-term, and so that we can be better prepared to support the capacity expansion. As for the return, let me emphasize it again, our gross margin will be 50% and higher. TSMC need to earn a proper return that can enable us to invest for the future expansion to support our customers' growth.
Okay, gotcha. I guess my question is that whether your desired ROI or desired margin change, right? Meaning you, for example, you hike the price by certain percentage points, but besides passing through the cost you just mentioned, whether that would lead to further margin expansion. That I think that should be core of my question. Thank you.
Right, Charlie. I think we just said that in the past we always say above 50% gross margin, but now we're saying that 50% and higher gross margins is achievable.
Okay, I see.
Okay. Thank you, Charlie.
Okay, understood.
Thank you.
Thank you.
Operator, can we move on to the next participant, please?
Right now we have Nick Goudois from UBS.
Yes, good afternoon. Thanks for taking my question. Just going back to the confirmation you just did on investing in Japan, should we understand that the portion of CapEx in 22-23 is incorporated in your overall guidance of $100 million, or would that come on top? And could you specify it if you can at all? And related question to that would be, what kind of capacity are we talking about for 22 and 28 nanometer? Thank you.
Okay, so Nick's first question is about our fab plans in Japan. He wants to know that with today's announcement, is the capex for the Japan fab already incorporated in the this 100 billion target that we have talked about previously, and also can we disclose the capacity for Japan?
Okay, Nick. The capex for this project, as we said last time in last quarterly release, was not included in the $100 billion budget that you mentioned. So it will be incremental. Other than this, we really are not able to comment on the investment amount and other details until after our board's review and approval.
Right. Okay. Fair enough. Understood. Going back to N3 and N3E, I mean, you talked about an improved process window for N3E. Is that the only main difference, or is there a difference in performance as well between the two? Thank you.
Okay, so Nick's second question is on N3E. He notes that we have talked about the improved manufacturing process window. He wonders if there's any other improvements in things like performance and etc.
There's a difference. As we said, N3E is an improvement in the manufacturing window. And however, the majority in the design rule or something is similar. We using the N3E to enhance the manufacturing window with a better performance.
Got it. Thank you very much.
Thank you, Nick. Operator, can we move on to the next participant, please?
Next one, we have Laura Chen, KGI.
Hi, thank you for taking my question. I think we are talking about seeing the solid demand across the world thanks to TSMC's strong position and technology. But on the other hand, on the demand side, we are also seeing that the smartphone growth is slowing down, in particular in China. So I think back in the earlier this year, we mentioned about a 5G smartphone shipment. We estimate that will be 500 to 550 million units. Just wondering, do you still keep that target? And also, do you have any idea or preliminary projection for the 5G smartphone into next year? And also, what if the smartphone, if 5G moving toward more like a lower end or mainstream, that kind of a segment, what's the implication to TSMC? That's my first question. Thank you.
Okay, Laura. So Laura's question is focusing on the smartphone. She notes that recently it seems the smartphone momentum in markets like China are slower. So she's wondering about what is our forecast for the smartphone market this year, as well as how do we see the 5G penetration this year, and then also the trend for the next few years. Is that correct, Laura?
Yes, thank you.
Okay, Laura, let me answer this question. We see the proliferation of the 5G smartphone is still higher than the 4G at the same period of time before. And also, we're looking at about probably slightly over 500 million units of 5G smartphone for this year.
Right. So do you have any preliminary thought about the next year growth? And would that mainly driven by the lower end segment? If that case, what's the implication to our outlook? Yeah.
We'll update you about that information in January.
Okay, thank you. And And also, my second question is also regarding our capex intensity. We already talked about the 3-year horizontal, but just wondering that do we still expect the capex intensity to maintain high beyond 2023, since we are launching a gate-all-around or 2 nanometer in 2025? So can we expect TSMC will start to bear fruit like our previous capex intensity hike back in 2011, and thus we will maintain the high CAGR growth going forward? Thanks.
Okay, so Laura's second question is on capital capex intensity. She's asking, what is the outlook for our capital intensity beyond 2023? Will we still have a very high level of capital intensity? Or she notes back in, the 2010, 2011 period, of course, our capital intensity was higher, but then we were able to harvest the growth and, capture the growth. So how do we see the next few years playing out?
Okay, Laura, in 2020, the capital intensity was 38%. 2021, this year, it's going to be over 50%. As we said earlier, CC mentioned this earlier, our capex spent every year in anticipation of the growth in the future years. So if we think the future growth outlook is good, then there's a possibility of higher capex. We're entering into a higher growth period because of the industry megatrends of 5G and HPC applications, plus the silicon content increase. So the higher capital investment in the next few years is appropriate. As a result, we expect the capital intensity to be relatively higher than previous year, like in 2020, for the next 2 to 3 years, before gradually coming down maybe to mid to high 30s level from what I can see at this moment. And your observation on the previous investment cycle in 2011 to 2014 will be a good one.
Thank you. Thank you very much.
Okay, thank you, Laura. Operator, can we move on to the next participant, please?
Next one to ask questions, Sebastian Ho, Neuberger Berman. Go ahead, please.
Hey, thank you for taking my questions. I only have one. It's on pricing. So I think last quarter, the company talked about firming up pricing to reflect the cost. And based on the higher long-term gross margin guidance that the CFO gave this time, 50% plus, I'm curious if this round of pricing adjustment is enough to observe the higher capex intensity only for this year or next multiple years. I have a follow-up to this question, so I will stop here.
Okay, Sebastian, his first question is on pricing, and that we have talked about firming up pricing, actually also talking about selling our value in the past. So he is wondering, now that we say 50% and higher gross margin, does that mean it is enough to cover the cost?
Okay, Sebastian, let me answer this way. Well, first of all, we're not able to comment on detailed pricing discussion with the customers. But we work closely with the customer to provide our value. And after providing our value, we're now expecting that a long-term gross margin of 50% or higher, 50% and higher is achievable as compared to the above 50% gross margin previously.
Got it. So my follow-up is that given that the next couple of years capex plan is still fluid, and I think CFO also mentioned there could be upside to our capex plan because of the Japan or any other reasons. So does that imply this will be a continuous adjustment, meaning that it won't be just one shot, but that we will evaluate the future pricing and what kind of value we can offer to customers based on the capex, based on and also to balance the structural profitability. So that means that we may continue to see potential upside in the pricing coming years.
Okay, Sebastian, so your follow-up is, again, let me summarize it. I think Sebastian is asking, our pricing, is it sort of a one-time, or will this be sort of an ongoing thing?
Sebastian, this is C.C. Wei. Certainly, I will not be able to comment on the pricing discussion with our customers, but we work with them and we continue to plan our capacity and sell our value. The capacity is one of the very important value of TSMC to support customers' growth. And so our pricing is accordingly with our value, and so we prepare for that. If this is a one-time or this is not, it's not a question. We do it strategically and not optimistic, and continue to work with our customer.
Got it. Thank you, CC and Wendell. But at least I think we can make a fair conclusion that the higher margin guidance outlook this time is a strong reflection or evidence of that the customer is willing to pay higher because of we offer value-add service. Is that right? Fair to interpret as it?
Yes. Simple.
Got it. Got it. Thanks.
Okay.
That's all from me.
Okay, thank you, Sebastian. Operator, can we move on to the next participant, please?
The next one to ask questions, Mehdi Hosseini, Susquehanna International. Go ahead, please.
Yes, thanks for taking my question. I want to go back to your commentary on N3 and N3 Plus. Can you tell me how I should think about EUV double patterning and how it will impact your cost structure? And I have a follow-up.
Okay, Mehdi's first question is about on N3, and actually, Mehdi, it's N3E, not N3 Plus. So his question is on N3 and N3E. He's wondering about the impact of things like EUV and double patterning. What impact does this have on the cost structure for N3 and N3E?
Well, let me answer that question. From N3 to N3E, we provide a better value on the transistor performance and have a better manufacturing window. As for the cost, they are similar. But we think our customer will enjoy a better yield, better defect density, and better transistor performance.
Okay. Thank you. And my follow-up has to do with your earlier commentary on customer prepayment. In the past, you've had one or two largest customers that have provided prepayment. Should I assume that there is a diversification, a larger number of customers that are providing these prepayments?
Okay, so Mehdi's second question is on customer prepayments. He observes that in the past we may have had one or two customers to do prepayments. He wants to know, are we seeing a diversification? Are we seeing a larger number of customers doing prepayments today?
Okay, Mehdi, let me answer this question. Yes, in the past there was only one or two customers providing the prepayments. But as we've been talking now, we expect to invest higher capacity, higher capital expenditures in the next few years to satisfy the strong demand. And in order to secure our customers' commitment, we are able to secure the prepayments for some of those customers. And the number of the customer I cannot disclose, but it's more than before.
Thank you.
Okay. Thank you, Mehdi. Operator, can we move on to the next participant, please?
The next one will be Rick Shi from Daiwa Capital Market.
Hi, this is Rick, and thank you so much for taking my questions. So the first question is about It's like a follow-up to Bruce's question earlier about the disconnect between sell-in and sell-through demands. And I think CC mentioned that he doesn't rule out the possibility of inventory correction. May I know if that happens? When do you expect that to happen? And also, if that happened, which area would feel the more impact in terms of technology node and in terms of the end applications? Thank you.
Okay, so Rick's question is again going back to the disconnect of sell-in versus sell-through, and also that we have said we do not rule out the possibility of an inventory correction. Rick wants to know if one were to occur, when would it occur? What particular end segments or applications could be more impacted?
Rick, I said we do not rule out the possibility. It's just a possibility. And all I say is TSMC's capacity will remain very tight in 2021 and throughout 2022. Which market sector? So far, we observe a little bit soft in smartphone and PC market. But if you ask me to predict, I cannot give you a very accurate prediction. We are the only one, I can give you a hint as we continue to say, it's not for the semiconductor industry. The demand is not only come from the unit growth, but also is increasing silicon content in end devices. So even you saw some smartphone unit become soft or even decrease, that doesn't mean that semiconductor or the business or the demand will drop. Did that answer your question?
Yeah, perfect. Yeah, that's very good. Thank you so much. And the second question is on the technology migration. I remember that the 7 nanometer, you defined a 7 plus as a node for you guys to have a very good transition of EUV. So I'm just wondering if are you going to do the same thing to define a particular technology node for the GAA transition?
Okay, so Rick's second question is about technology migration and transition. He notes that in N7 we had introduced also N7 Plus to transition and start to adopt EUV. So he's asking if we will incorporate a similar transition as we move to a new transistor structure.
Well, I don't think we can have any more information to share with you as we move from N3 to go to the next more advanced node. Today, I only announced that the N3 to N3E that will have a better transistor performance and better manufacturing window. For N2 GAA, we will share with you when we are getting more ready.
Okay, thank you. Thank you so much.
Okay, thank you, Rick. In the interest of time, operator, let's take the last two participants, please.
Okay. Now, the one is going to ask question is Chris Sanford, Cowen and Company. Go ahead, please.
Yeah, hi. Thanks for taking my question. I just wanted to follow up. One is on CC's prepared comments. You said the industry is going to maintain a higher level of inventory. Can you tell us which specific end markets and which specific technology nodes you're seeing those higher level of inventories? And your comment that you're seeing softness in smartphone and PCs, is that a function of end demand slowing, or is it a function of not being able to get the components to make those products? And then I had a quick follow-up.
Okay, Krish. Krish's first question is on the higher level of inventory that we see preparing in the supply chain. He wants to know which end markets or applications specifically, or which technology nodes do we see this higher level of inventory. And then also the slower momentum in the sell-through of smartphone or PCs. Is this related to component tightness or shortages?
Well, let me answer the question. The high level of inventory is caused by some of the necessity for not to be disruption in the supply chain. So it's across the board. Actually, it's not any node or any product. It's across the board. And we say it will be continue for a period of time. That is because of today, all those elements to drive the people to prepare more inventory still continue to exist. Did that answer your question?
Got it. Yes, it did. It did. And then just like the second part of the question, which is the softness in smartphone and PCs, is that end demand related or component tightness related? And then I'll ask my final question along with it. The gross margin upside you saw in Q3 from back end, was it a one-time thing or is there more upside for that in the future? Thank you.
Okay, so Krish's question also sort of the weakness that we see in areas like smartphone and PC, is this related to end demand or is it related to component shortages?
Both, actually. Let me answer the question quickly. Actually, end market is a little bit soft, it's slow, but we think it's partly due to the component shortage.
And then the second part, or Krish's second question, I should say, is on the gross margin side, and also the improved back-end profitability.
Right. The back-end business is sort of seasonal. It has high season, low season during the years. So normally second half it's high season, especially third quarter. As a result, the profitability of back-end will be better in that quarter.
Thank you very much, gentlemen. Thank you.
Okay, thank you. And then, operator, we will take the last participant, please.
Yes, the last one to ask questions is Andrew Lu from Sinolink Securities. Go ahead, please.
Thank you for taking my questions. CC, I want to ask, this year you just guided 24% year-over-year growth. I think this number is probably in line with the industry. It's clear we have a stronger growth in advanced technology, but losing some share in the legacy. Earlier, Randall mentioned we will build more mature technology based on the customer's demand. So if our CapEx unchanged, we adjust down our advanced CapEx, but increase more CapEx on mature technology.
Okay, so Andrew's first question, he's looking at our growth in 2021 to be around 24%. He sees the strong leadership in the advanced nodes, but his note is that we're losing share in the mature nodes. So going forward, will there be any adjustment in our CapEx strategy, leading versus mature? Is that correct, Andrew?
Yes, correct. Thank you, Jeff.
Andrew, let me answer that. We did not change our strategy or philosophy in our CapEx plan, but certainly the most important thing is we are working with our customer to support their demand. This is very important. That including on the specialty technologies. We share them to increase the mature nodes capacity, but as we announced that Japan fab actually is a mature technology. It's a 22, 28 node.
So can we say that in the future we should have a higher percentage of CapEx in terms of total CapEx compared to the past?
So Andrew really wants to know. Yeah. Well, Andrew wants to know: will the CapEx spending proportion of the mature nodes versus leading edge? Will we have a higher proportion for the mature nodes in the future years?
Andrew, Not yet, because of we increase our capex, right? So even the same proportion, the mature nodes, actually we spend a lot of money also. Did that answer your question?
Yeah. Yes. My last question is, since we are adjusting our price based on the cost increase or whatever, how do we factor into our model for next year? What kind of blended ASP increase should we factor into our model? Because I have been observed average price blended basis for the last 3 years, including this year. Our price for last 3 years, including this year, about 7 to 9%. So if next year we have a additional adjustment on the apple-to-apple pricing level, should we say easily to have a 10% blended basis increase on ASP? Thank you.
Okay, so Andrew's second question is on the blended ASP outlook. He wants to know, in essence, can he model a 10% or greater blended ASP increase for 2022?
Andrew, it's too early to comment on 2022. We will provide you more color in January. Plus, we don't really comment on ASP anyway.
Thank you.
Okay, thank you. This concludes our Q&A session. Before we conclude today's conference, please be advised that the replay of the conference will be accessible within 4 hours from now, and the transcript will become available 24 hours from now, and both of which are available through TSMC's website at www.tsmc.com. So thank you for joining us today. We hope everyone continues to stay healthy and safe, and we hope you will join us again next quarter in January. Goodbye and have a good day.